Hi guys, how are you doing? So in this video, we're just going to go through some trading basics and actually talk through some key aspects, I guess, and just some key terminology that we use and the trading industry uses as a whole, which will just benefit you from the start and you won't be confused about these things. I think that's the best way to put it. So let's have a look. First of all, you'll hear us talk about different currency pairs in different words. So for example, you got currency pair euro dollar, and as like some of these are really simple and some of them just get more confusing because of the different names and stuff like this. So when we trade the euro dollar, EUR-USD, the currency pair, you're trading the euros against the United States. It's as simple as that. And we just got the euro dollar. You'll also hear us call it EU. So we do tend to use the first letter of the first country or the first eurozone in this example. So like pound dollar would be GU, or we just say pound dollar. You will also hear people call like specific currencies by different names, such as the New Zealand currency maybe called Kiwi, like is called Kiwi. There's just names. I can't remember where all of these came from, but that's just the way it is. Like, for example, the pound dollar is actually called cable because of the transatlantic cable that runs underneath the United Kingdom and the US. So, and then they renamed it. They renamed euro dollar actually fiber, but it hasn't been like accepted by many. So, but yeah, just as a way to like introduce it to you guys, you'll hear us call these like in different names, but they will mean the same thing. So like dollar loony, for example, we never say that. We just say dollar Bieber, or we just say dollar CAD. But yeah. So next one, spread. So you quickly see when you log into your MT4 or you actually on TradingView as well, you quickly like see spread and like how different currencies are quoted. So on the left hand side, we also have the base currency. That's always going to be whatever you want. If you want to buy or sell, that's what you're going to be buying or selling in this case. So the euro is always the base currency against any pair whatsoever. It's been like this since the 1990s, I believe, just for convention, I think. So the euro is always going to be the first pair. And then the dollar is sometimes the first pair. It's not always. So for example, euro dollar, it's the dollar is the second, is the quote pair. Pound dollar is the quote pair. I'm ready for top of my head now. Aussie dollar and then New Zealand dollar as well. The dollar's the second pair, second in the pair, the quote, not the base. So when you see like the spread like this, so on the left hand side you've got your bid price, and on the right hand side you've got your ask price. So on the left hand side is the amount in dollars. It's the amount in dollars to actually buy €1, and then on the right hand side it's how much €1 buys this amount in USD. So if I want to buy euro dollar, I'm going to be paying the bid price, and if I want to sell it, I'm going to be entered at the ask price, and the difference is the spread. So in this occasion, the fourth digit here is the pip value, and then fifth digit is the pipette. So in this case, you've got a spread of 0.5 pips, which is quite a good spread to be fair on euro dollar. So that's actually what you're going to be paying the broker when you enter your positions. It's as simple as that. So you always the one on the left hand side you always see as how much it costs, how much in amount in dollars to actually buy €1, or if this was GU, for example, pound dollar. So how many dollars does it take to buy one pound? And that will be around 140s. So yeah, it's as simple as that. Moving on, trading out. So you'll hear us refer like to, let's say, during London, during Asia, during New York, like you hear us talk about these things, and what this refers to is just the trading hours of when the stock exchange for that given continent or for that given country is actually open. So when we talk about Asian session, we'll talk about what happens in the market from 10 p.m. to around, I'd say the Asian session ends around 7 a.m. So from 7 a.m. that's when we have the London session. London traders come in. The London Stock Exchange isn't open, but the London traders come into the market, then that's when they start the trading session. So when we do say, oh, this has happened in the Asian session, that's what it means. So between 10 o'clock and 7 a.m. in the morning. You also hear us talk about day end. So day end is going to be at 10 o'clock, just after the New York session is finished. That's when you have the daily candles in the market. So it's from 10 p.m. one day to 10 p.m. the other day. And then obviously, when we talk about the London session, the London Stock Exchange is open from 8 till 4:30, no, till 5, if I'm correct. I can't remember exactly. But yeah, we see the most volatility in the market between the London session and New York session. Like between the periods, as you can see here, between 1 and 5, the liquidity actually in the market is 10 times greater than it is on average during the Asian session, so Australia and Tokyo, like during that side of the market. So that's when we are like, you see the biggest moves in the markets, because there are the most people in the market involved at any given time. And just as point of reference, you see the New York Stock Exchange opens at 2:30, like GMT time, and closes at 9:30. But obviously, it's different in New York, and it opens at 8:30 and then closes at 4:30. Yeah, we close at 4:30. So you need to know these, because sometimes you might see different news releases. If you haven't changed your economic calendar, like different news releases where it's in EST, not GMT. So just be aware of that. But you just add 5 hours basically to the EST time to get the GMT time. But yeah, we will reference these a lot, because we are always active on the London New York session. And then we will refer to different sessions. Our trading strategy revolves around like looking at the Asia session itself. So just be aware of us saying, oh, this happened Asian, and then we come into London. Like, we don't mean when the London Stock Exchange opens, we just mean London hours. So from around 7 till 4:30, when the London traders are active in the market. You'll see the same thing in New York, even though the New York session doesn't open till New York Stock Exchange doesn't open till 2:30. From 1 o'clock, 1:30, you'll see like the trading volume will start to pick up, and you'll see bigger moves in the market, simply because these traders are starting to come in and sit at the desk and start the trading for the day. And the last thing I just want to cover is just capital and position sizing. So actually calculating the size of position. So if I bring in position size calculator, it's something you'll have to get used to as we go along. So position size calculator is going to allow you to calculate a given position of your trade based on the risk you want on you. Based on the risk of your accounts, like you want to risk at any given time. So just as an example, if my trading account is in pounds, I'm going to fill it in as pounds. And this is just a risk calculator I found. I've got different apps you can actually download for MT4, or you can have apps on your phone, or when you use CTrader, we use CTrader a lot. The risk calculator is actually within CTrader, so it does everything for you anyway. But if I just quickly run through this, so you've got your account currency, which is quite simple. Your account size in this currency. So if I just do 5,000, I've got £5,000 in my account. So what is the risk I'm willing to have on any given trade? Let's say 2%. What's my stop loss in pips? So you understand how we set stop losses in further lectures. So for example, I'm going to say 10. And what is the currency pair I am currently trading? Let's go with euro dollar. And what is the currency pair? What's the price I want to trade euro dollar? So let's say 121.00. So let's calculate it. So if we just go through this, so the money that's going to be at risk is £100. How does it work this out? So if I got £5,000 in my account, 1% of 5,000 is going to be £50, and then 2% is going to be £100. So straight away you can see the risk calculator is working this out correctly. And then this allows me to trade 121,000 units, which is 1.21 lots. So we'll go through lots in a minute. Basically, one lot in the market is 100,000 of one currency against the other. So I'm allowed to trade 121,000 of the pound against the dollar, essentially. And then in lot terms, because in your MT4, you'll have to enter specific lot amounts. That calculates to 1.21 lots, as one lot is 100,000 units. A mini lot is 10,000 units, and a micro lot is 1,000 units. So that's key things for you to remember going forward. If, for example, let's say I've only got a £1,000 account, calculate this, see this changes automatically. So now I can only trade less lots. I can only trade 24,200 lots, which is 0.242. and the 0.243 is something you'd enter in your MT4 calculator. You will never encourage you to trade live at all ever, and then you'll have to develop being comfortable with this risk and actually calculating positions for yourself, because it's quite easy to make a mistake. Because let's say I just put 2-0 here by accident, all of a sudden I'm risking £200 on a £1,000 account, and if I put this into the market, then I can be £200 down already if the trade goes 10 pips against me. So this is just something that you need to be aware of going forward, and you need to really get involved and understand the risk calculator, how it calculates your positions. But that's something you'll develop throughout the course. So and just moving on, so understanding lots is just something I talked about. You need to know 100,000 units is one lot, and then 1 mini lot is 10,000 micros, 1,000 units. Your equity, so you'll see on the MT4 you have a sum, which is your equity. So your equity is going to be account balance plus minus any profit or loss on your trades, active open trades, open positions. So if I have a £1,000 account and I'm currently of an open position and I'm up on that position for £50, so my equity is going to be 1,050, whereas my balance is going to be 1,000, because I haven't took my profits yet. If I take my profits, my balance is going to change and match the equity. Simple as that. So simple as that. Margin is the percentage of the full value of a trading position that you are required to put forward in order to open your trade. So margin actually enables traders to increase their exposure in the market. So your profits will be amplified and your losses will be amplified as well. So what this means is essentially there's rarely you'll trade without any leverage in the market. So in the UK on average, I think most forex brokers required to have around a 3% margin in your trade. So that means if I want to open a position worth £100,000, I need to have £3,000 in my account. That doesn't mean you should be opening £100,000 of positions for only £3,000, but that's basically what margin is. It's how much leverage you can use according to your actual balance on your account. But obviously, once you start implementing risk management rules, you're not going to lose the whole account at once. And then obviously, leverage is how many times I can leverage the position. You'll see we use 100 to 1 leverage most of the time. So as the trade size increases, so does the amount of margin used. So if you have more trades running at the same time, your margin is going to be more used up. And generally speaking, if you use up your margin, you've only got 20% less on your account and you've got open positions, you'll get a margin call from a broker where you either have to add more funds to your account or you have to physically close out your positions. But you'll start to understand leverage and margin as you go on, and you start opening demo accounts and trading on demo. So I'm not going to go through too much in this here. And the last thing is just thinking in terms of percentage rather than pounds or dollars. We'll talk about this more in the psychology section and risk management section, but from the start you want to start looking at your account in terms of percentages and your risk reward rather than physical pounds or dollars. Because if you focus on the dollars, you'll be focused on the money and you'll never take risks, calculated risks in the market to actually explore what you can achieve. So from the get-go, you just need to always think about percentages, and we'll always refer, you won't hear us talk about how much money you've made on a trade. You hear us talk about how much percent we've made on a given trade. But yeah, that's that. So I hope you guys enjoyed this nice and sweet introduction, and I'll see you in the next lecture.